Okay, so for this video, we'll be going through the paper by Oliver Bunn and Robert Shiller. It's called Changing Times, Changing Values, a historical analysis of sectors within the U.S. stock market from 1872 through 2013. And so back in 1988, Robert Shiller and Campbell published a paper regarding what they called the Cyclical Adjusted Price Earnings ratio, the CAPE. And basically, they adjusted the past 10 years' earnings according to inflation and averaged those earnings to get a real price earnings ratio. And then they were able to show that this CAPE measure was able to predict returns of the overall stock market over the period under their study. So now they want to maybe use that CAPE measure within different sectors of the U.S. economy. And so this paper explains their process and their findings regarding using the CAPE to predict stock returns within the different sectors in the U.S. stock market over a very long period of time, 1872 to 2013. So let's dive in. Okay, so this right here is figure 1, and it gives us the price indices for the overall U.S. stock market, as well as the price indices split into the 3 sectors that the authors have under study. We have the industrials, utilities, and railroads. And so we have to understand, since this data goes back to 1872 through 2012, way back in 1872, stocks were basically split into these 3 sectors, with railroads being what we commonly think of as railroads, and utilities as well. And then the industrials sort of were a catch-all of every other possible industry. But since then, industrials have been split into the sectors that we know of today. For instance, consumer discretionary, consumer staples, and healthcare, information technology, etc. So when we think about this industrials sector that we have here, the authors have included every stock in the S&P 500 unless it's classified as a railroad, utility, or a financial. The railroad index back in the late 1800s and early 1900s represented a very large part of the stock market at that time. And so railroads was a very prominent index and a piece of the S&P 500. It represented about 425 stocks and then 400. Now railroads are less common. And so this index today represents 4 stocks: Burlington Northern, CSX, Norfolk Southern, and Union Pacific. But for purposes of this study, the authors have kept the railroads separate. And then utilities is certainly electric providers, water, gas, etc. So all that to say, we need to think about these different sectors, sort of how they were back in 1872 to understand the changes in index prices over time and the types of stocks that are included. So anyway, what we see here is that we have the overall stock market here, and this is now the S&P 500, but back in the early 1900s and late 1800s, there were only maybe 400 stocks and 90 stocks at the time. So for further analysis or explanation of what all is included in each of these indexes, you might go read the section in this paper. So anyway, what we have here is a log of the price indices. So it gives us a perspective on the percentage change and from quarter to quarter over time. The authors don't have them here, but they told us in the text that $1 invested in the stock market in 1872 turns into $256 in 2012. So that's a 256-fold increase in your dollar. And inflation-adjusted return is only 14 times. Industrials performed a lot better. Your dollar invested in industrials went to $671 by 2012, with the real return being 38 times, and that means it's adjusted for inflation. Your dollar invested in utilities in 1872 only increased to $16 by 2012, and actually on real terms, you lost money. The real return to utilities over that time was a negative 11%. So by owning utilities over that period of time, you're actually worse off from a purchasing power perspective. And railroads increased 167-fold, and it was 9 times real terms. Okay, so now we're looking here at figure 2, and this has the earnings for each of the sectors. So we have all stocks, industrials, utilities, and railroads. And the solid line is the nominal earnings, and the dotted line is the real earnings for each of these sectors. And so this is the second component of the CAPE. Figure 1 that we saw before was the price piece, and this piece is earnings piece. So the authors want to show the change in earnings over time, the earnings growth for each of the sectors. For all stocks, the earnings grew on an inflation-adjusted basis 11-fold. So in 2013, the earnings were 11 times higher than in 1872 on an inflation-adjusted basis, so the real earnings. The industrials earnings increased 12-fold, based on inflation adjusted. Utilities inflation adjusted earnings actually went down 65%. So there was actually negative growth in their earnings, and the railroads saw an eightfold increase in their real earnings from 1872 through 2012. And what's interesting to see here is that the rankings on which sectors had the highest earnings growth kind of correlates with the prices that we saw in Figure 1. So the sectors with the higher earnings growth ended up having higher price increases, and no sector, interestingly, had a negative 12-month earnings. So it's interesting that there's no negative 12-month earnings over the period, given the trajectory of these industries, but railroads began their prominence back in the 1830s, and they had a tumultuous beginning there, and there was a big frenzy in the markets to buy stock in railroads. But by about the 1870s, railroads had become a more developed sector, and that's when our data began. So we don't see all the major ups and downs that happened in the mid 1800s. And utilities had an interesting beginning as well in the late 1800s. The natural gas and electricity became put in place, with electric power being provided to homes, pretty much to most homes by the 1920s. But of course, for 1929, all of the industries had a pretty enough time in the Great Depression there. But after the 1929 period, just like the railroads, the industrial sector became more developed and boring. But the industrial sector is the one whose earnings did really well, increased the most out of all of the sectors. And as we discussed, this sector is a catch-all for several different industries and types of companies. So from the radio and the automobile coming into existence around in the 1920s, as well as other inventions such as computers and phones as we get closer to where we are today. But these earnings seem to move in line with, or rather, the returns to the stock, the total return, move in line with these earnings, as we see in the next figure, Figure 3. So here we have Figure 3, and this is the real total return index for stocks, and also for each of the sectors that we're looking at, the industrials, utilities, and railroads. And so these are the returns of capital appreciation of the price of the stocks, as well as the dividends and reinvestment of the dividends over that time. And so we see this kind of falls in line with the trend that we saw in the earnings in Figure 2, as well as the trend in price that we saw in Figure 1. We see that the industrials performed best on a total return basis out of a competition with utilities and railroads, as well as the overall stock market. We also see that the railroads beat the utilities, as they did in earnings and price, but the utilities are close behind. It's interesting to see how closely the utilities and railroads correlate with each other over time. Clearly, the railroads beat out the utilities in the 2000s. We see here the big hit in 1929 as well through the Great Depression. But for utilities, even though we saw in Figure 1 the price index had a real decline with the dividends included in reinvestment, we still get a pretty good return. The utilities increased on a real total return basis by over 2,000-fold increase. Although these industrials total real return increased by 19,600-fold increase. Okay, so now that we have an understanding of the historical returns of each of the sectors as well as the overall stock market, we're getting into the cyclically adjusted price earnings ratio as it relates to the overall stock market and each of the sectors under study here, the industrials, utilities, and railroads. So the way that he builds the CAPI, the cyclically adjusted price earnings ratio, is in the numerator. He has the price piece, price earnings ratio, so price to earnings. And the price piece, he makes this be the total return price. So that was the amounts we saw in Figure 3 before. So the price adjusted for reinvestment of dividends as well. And in the denominator, he has the earnings piece. So he adjusts the earnings on the past 10 years for inflation and geometrically averages those. And also he adjusts them for the ratio of the total return price to the normal price of the index, which we saw in Figure 2. So that puts the total return price and the earnings more in line. So anyway, this is basically a price earnings ratio, although it uses the past 10-year average of returns as the earnings piece, rather than our normal price earnings ratio, which usually takes the earnings over the past 12 months. So in this case, it takes more of a longer perspective over a business cycle, potentially. And by adjusting them for inflation, we put them more in line with today's dollars. So anyway, here we have charts of the CAPI for each of the sectors as well as the overall stock market. And we can see some common themes here where we have 1929, very high CAPE. And so a very high CAPE would signal maybe an overvaluation because the price relative to the past 10-year average earnings adjusted is very high. And low CAPE would maybe signal an undervaluation. So in more recent times, maybe the tech bubble of 2000, 2001, we saw a very high CAPE in various industries, and the Great Depression as well, 1929. And good times to buy might have been around 1980 or so in all of the sectors, and maybe also the start of the Roaring 20s, and shortly after the Great Depression here, when it started up for wartime. And there are also big differences here. The utilities CAPE went to over 60, it looks like, during the Great Depression, but the industrials stayed below 40, and railroads right around 20. So industrials or utilities took a big hit, or rather their price was way higher than their past earnings than the other sectors. But then looking at the tech bubble here around 2000, industrials almost got up to 60 as a CAPE, whereas the railroads and utilities stayed pretty low around 30. All right, so next we have figure 5 here, where we have a couple of charts that are comparing the level of CAPE to the future 10-year returns. And these charts are flipped, so let's turn them around a little bit so we can see it a little better. Okay, so we have on the x-axis of both of these is the CAPE. This is the CAPE level. And then on this right side, we have the relative CAPE. How they devise this is going to be explained in the next section, but I believe it's going to be maybe relative to the average CAPE. But we just need to understand that as the level of CAPE decreases, so does the next 10-year return across the 100 years that we're studying here. And this is a pretty interesting, very pronounced negative relationship here. And each of these, we can see the year and the month, or rather the quarter. But long story short, across all these observations, the lower the CAPE, the higher the next 10-year returns. Okay, so next here in figure 6, they've used the same data that we saw from table 5, but they've split it into tertiles. So maybe the bottom 1/3 of CAPE, and the middle 1/3 of CAPE, and the top 1/3 of CAPE observations, and to see what is the average return in each of these thirds of the CAPE population. And again, as we saw in figure 5, we see a much higher next 10-year annual return, about 10% for the lowest tertile of CAPE ratios, and then for the highest CAPEs, we see about a 3% annual return. We have the same monotonic relationship here in the relative CAPE as well, although less divisive. Okay, so now we're down to figure 7. We're going to look at figure 7 through 9 in quick succession, because these are basically the same as figure 6, only now we have them disaggregated into the different sectors. So this is the industrials, and let's turn it sideways so we can see what's going on here. We have sort of the same distribution as what we saw in the overall stock market, where lower CAPEs have resulted in higher next 10-year returns, and looks very similar to the overall stock market CAPE that we saw in figure 6. Also, we see a monotonic decrease in the annualized average 10-year returns as we get a higher and higher CAPE, and that was for industrials. Now let's take a look at figure 8, which is for the utilities, and we see a pretty much the same scenario, where we have lower CAPEs resulted in higher 10-year returns following the reading of that CAPE. And going down to look at the tertiles, you see an even more pronounced monotonic decrease as the CAPE increases, and that works for relative CAPE as well, and that was for the utilities. And going on down, let's take a look at the railroads, which are a bit less fit of the line, whereas the other sectors, as well as the overall stock market, showed an increasing next 10-year return with lower and lower CAPEs, but the railroads seem to be kind of all over the place, and not necessarily representative of that distribution that we saw in the utilities and the overall stock market and the industrials. And it looks like it's mostly due to the 90s here. We got a 97, 98, 99, where things really started to, or rather the expected relationship between CAPE and long-term return began to diverge. We got some 2000s here that are really outside of what should be this fitted line right here, but instead, due to these outliers, the line ends up being like this. So let's go down to the tertiles. We see still we've got a monotonic decrease here in the average in the tertiles as the CAPE increases. We have a lower and lower next 10-year return, and that was for the railroads. Okay, now we're down at figure 13, where we have the relative CAPE here for all stocks, industrials, utilities, and railroads. And the authors have described their calculation of the relative CAPE as being the CAPE at each point in time divided by the prior 20-year average CAPE. So the CAPE is relative to itself. So for instance, the relative CAPE of all stocks would be its CAPE at a point in time divided by the previous 20 years average of CAPE. Same vein for industrials. Its relative CAPE would be its CAPE at a point in time divided by the previous 20-year average CAPE. So basically, it's a ratio within itself, not necessarily relative to the other sectors. So we remember in looking at the figures 7 through 12 that the relative CAPE chart between the next 10-year returns and the relative CAPE fell pretty much in line with the regular spot CAPE and the next 10-year returns. So we know there's a good basis for that analysis here. It's interesting to note here on the scale we have basically 0 to about 4.5. So 1 would basically be where the spot CAPE is equal to its previous 20-year average CAPE. And so maybe we might conclude if the relative CAPE is above that, that particular sector might be overvalued or relatively overvalued. And then if it's below 1, it might be relatively undervalued relative to its own history. Okay, so now that we've gained an understanding of what the CAPE is from figures 5 through 12 and what the relative CAPE is from figure 13, the authors here are showing the comparison between those two over different time periods. So this time period is at the start of Q3 of 1902 through 2012. Then we have 1935 through 2012 and 1962 through 2012. And basically this percentage here is the correlation between the CAPE or the relative CAPE, depending on the column, and the subsequent 10-year return. So as we saw in figures 5 through 13, the higher the CAPE, the lower the subsequent 10-year return. So that's why we have a negative correlation between the two here. And we also have p-values here in parentheses, and we want these p-values to be as small as possible. Because the smaller the p-value, the more likely it is that this percentage is not 0. So we see here that the significance of the CAPE and relative CAPE are very negatively correlated with the subsequent 10-year return, no matter the time period that we observe, hanging right around the negative 50% in all cases. But what the authors want to emphasize is that we remember the railroads showed sort of a discrepancy between the CAPE and the subsequent 10-year return once we got up into the 90s, 2000s. And at that point, there wasn't as significant of a negative relationship as it was prior to the 1990s. So we see that here as we have our negative correlation and the longer time periods is a lot smaller. And once we even get closer up to the latter half of the 1990s, this CAPE gets very, very small. So that might lead us to believe that the CAPE is not a very good indicator of value for railroads, at least. However, now that we show the relative CAPE in this scenario, we see that the relative CAPE does a lot better job than the regular CAPE at showing the negative correlation between it and the subsequent 10-year return. So at least for railroads, it might be a better indicator of under or overvalue than is the regular CAPE. Okay, now we're at figure 14, and let's turn this sideways so we can take a look. But up until this point, we have looked at the CAPE of the individual sectors individually and in isolation. But now we want to understand, do the CAPE ratios of each of the sectors tell us anything about the under or overvalue amounts relative to the other sectors? And so what the authors have done is they've taken industrials and utilities as an example, and they've taken the relative CAPE of the industrials and divided it by the relative CAPE of the utilities and subtracted by 1. So this would tell us that if the relative CAPE of industrials is lower than the relative CAPE of utilities, then maybe industrials are undervalued. And this would give us a negative amount in this chart in the red line. So areas where the relative CAPE of industrials is lower than that of utilities might be in this area, right here, 1920 to 1932-ish. Also in the 1950 to 1965 range. Places where industrials might be significantly overvalued compared to utilities might be in the 1905 to 1920 range, 1935 to 1945 range, or in the 1970s and just before the technology bubble burst. So being above or below 0 would tell us whether industrials are over or undervalued relative to utilities. So now that we understand what the red line is, we can now go to the dotted line, which basically tells us the next 10-year return of the industrials compared to the utilities. So if what we said earlier is true, that if utilities or if industrials are undervalued compared to utilities, and that results in this red line being below zero, then we would expect this dotted line to be above zero at that time, because then the industrials would outperform the utilities if in fact they were undervalued now. So we should see opposing movements between these two. And in fact, that's sort of what we see. As the relative CAPE of industrials gets below that of utilities, for instance, in this part right here, the net subsequent 10-year return of industrials is much higher than that of utilities, as we see here. And from the other side of the coin, as the relative CAPE of industrials is much higher than that of utilities, we see the returns of industrials being much lower than utilities here. So we certainly see a negative relationship here between the difference of relative CAPEs and the difference in subsequent 10-year returns. And we have that visually here in the scatter plot, with this axis being the total return difference of industrials over utilities, and this axis being the relative CAPE difference of industrials over utilities. So as we saw in the line chart, as the relative CAPE difference of industrials begins to exceed that of utilities, we also see the returns of industrials to underperform those of utilities with this downward sloping line. And authors say this relationship is about a negative 40% correlation. And so next we have figure 15. This is the same as figure 14 that we just looked at, although this one is industrials versus railroads, whereas the last one was industrials versus utilities. So they're doing the same analysis where we have the percentage difference relative CAPE of the industrials over railroads in the red line, and then the difference of long-term total return of industrials over railroads, and then the scatter plot of the same down here. And just like in figure 14, when this line is below zero, we would expect that industrials are undervalued compared to railroads and should therefore outperform railroads on the next 10 years. And therefore, we should expect negative correlations between them. And in fact, we do see that, where we've got a significant overvaluation of industrials compared to railroads. And so then the industrials underperform railroads here in the 1930s and also in the 2000s. Going down to the scatter plot, things are less clear. And in fact, the authors say that the p-value of the simulation of this is around 50% or 0.5, and that's not very good. So as we saw in the figures prior to this, railroads seem to be the culprit, where the valuations of the CAPE seem to not match the subsequent 10-year returns that we would expect, as it does with the industrials and utilities. So this might lead us to believe that the subsequent 10-year returns, when railroads are entered into the picture, might not be very predictable. But in the next table, the authors try to refute that claim. So let's take a look at the next table. So here at table 2, we have the correlations between the differences in the relative CAPE indicator and the long-term returns between the different sectors. So we've got industrials versus utilities, industrials versus railroads, and railroads versus utilities. As we saw in figure 15 and 14, the relationship between the relative CAPE difference between these two sectors and the long-term returns between these two sectors is negative. So if the relative CAPE of one sector is lower than the relative CAPE of the other sector, then its subsequent 10-year returns will be higher than the subsequent 10-year returns of the other sector on average. And that's why these correlation figures here are negative. And we see here that if we were to start this series comparing these in 1902, the negative correlation is not as significant. We have a pretty small negative correlation here, also a very high p value, so that would lead us to believe that the returns aren't predictable. However, at each change in starting point, where we get more and more close to present day, this one we started in 1902, here we started in 1935, here in 1962. As we get closer to present day, in the past 50 years at the time of the study, the correlations get significantly negative with very low p-values, both things that we do want to see. So the relationships of these two variables certainly work out better post-1962 than they did before then. Okay, so now that we understand and have some significant evidence that the CAPE ratio can somewhat predict the subsequent 10-year returns for each of the sectors as well as the overall stock market, although maybe not so much for railroads, but we pretty well established that there's a negative relationship between the CAPE and the subsequent 10-year return. So the authors want to understand, is this because the numerator of the CAPE changes, and that would be the price, price divided by earnings, or do the lower CAPE sectors outperform because the denominator, the earnings, changes? So in a sense, do the lower CAPE sectors outperform 10 years in the future because the price increases more, or is it because the sector has more earnings growth? And to do that, or to figure out which one that is, the authors have compared the CAP-E on this axis to the long-term earnings growth over the next 10 years. And so the thought is that if the CAP-E ratio is higher, maybe investors are paying more for the future growth of the sector. So therefore, this CAP-E compared to the earnings growth should have a positive relationship. So the higher the CAP-E, the higher the future earnings growth. But indeed, we don't see that to be the case. We actually see somewhat of a negative relationship. And across figures 17 through 20, that seems to be a common theme across all sectors, and that the earnings growth is not higher for higher CAP-E sectors. So we can run through each of these figures now, but that leads us to believe that it's the price piece, the numerator in the CAP-E formula, that is the cause of the outperformance. And here we have utilities. We do have somewhat of a positive relationship there. And here we have the railroads. Really an inconclusive relationship here. Okay, so now we're down in figure 21. Over the next several figures, authors are doing a sensitivity study. Their thought was that, hey, the CAP-E uses a 10-year earnings horizon, so averages the previous 10 years of earnings, and then it looks forward over a next 10-year return horizon. And so they want to learn, is that the most appropriate set of years? And so to find out, they have set up these charts, and we can go through what these mean. Basically, they have the return horizon down here, so this is a subsequent return after they developed the CAP-E ratio, and they've developed what the return would be over 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 different years. And also the earnings horizon that goes into the denominator of the CAP-E from 1 up to 10. And then they have figured out what is the correlation between the CAP-E ratio and the subsequent X number of years return in the same way that they did in prior figures and the prior charts. And as we saw in the prior figures and charts, there was a significant negative correlation between the 10-year CAP-E and the subsequent 10-year returns. And so we see that here at this point, which is about negative 0.6, negative 60% correlation, and that's what we saw in the prior tables. So now this gives us an idea of what would the correlation have been between the CAP-E and the subsequent years of returns if we changed up the number of years for each of those variables. And so this point right here would be like a normal price earnings ratio. That's basically the prior 1 year, prior 12 months earnings horizon in the denominator. So in all cases, we see that the 10-year CAP-E over the next, with a return horizon of 10 years, performs the best if we're considering the most negative correlation as being the best. And the normal price earnings ratio didn't have as negative of a correlation. And so to back up here for a second, this is all stocks. This first one is the full sample from 1902 through 2012. This one starts in 1935 through 2012, and this one starts in 1962 through 2012. And so what's interesting to see about this chart is that the results are very much dependent on the return horizon, not so much in the earnings horizon. As we see, it's relatively flat in that regard. So really, no matter what earnings horizon we use, the negative correlation relationship comes primarily from the number of the return horizon number of subsequent years that we hold the security. So even if we were using the normal PE ratio, which would be this row right here, the negative correlation, or it becomes more negatively correlated as we increase the return horizon. So this would tell us that a higher PE ratio would result in lower and lower subsequent returns as we hold the security longer. And of course, the 10-year earnings horizon and the 10-year return horizon has the most negative correlation here, which is the CAP-E that we have been studying up until this point. And coming over here, we have the p-values of this. And of course, we want the p-value to be as small as possible. And that would give us evidence that these aren't just spurious calculations and that returns are actually predictable based on the PE. But we do see that the lowest p-value here is basically the price earnings ratio and holding the security for 10 years. But overall, the P values here are within the 0 to 0.10 range, which is pretty small, and gives us good evidence of these aren't just various calculations. But once we get into the more recent 50 years, the 1962 through 2012 period, these P values shoot up pretty high, and even 0.2 to 0.6. So that would go against the CAPI's ability to predict long-term returns. Next, we have figure 23, and this is the same as figure 21 before, but this is for industrials. Figure 21 was for the overall market. And we see here that the normal PE ratio, which has a 1-year earnings horizon, has significantly higher correlations between the CAPI and the subsequent 10-year returns than do lower earnings horizon, or rather higher earnings horizon figures. So as we increase the number of years of earnings in the denominator of the CAPI, the less correlated the CAPI becomes to the subsequent return. And this has occurred in the full sample since 1902, as well as the samples since 1935 and 1962. And also as our holding period, or the return horizon, increases, we also get better results. Next here at figure 25, we have the same sensitivity study for utilities. And in this study, again, we find that increasing holding periods, or the return horizon, results in more or less correlation between the CAPI and the return amount. However, as we saw in the all stocks and figure 21, it's almost apparent that the earnings horizon, that would be the denominator in our CAPI ratio, really doesn't matter a whole lot, as we see that with each change in the earnings horizon, there's not really a change in the color of these boxes. So the correlation is largely dependent on the holding period. Although we do see that holding periods of 10 years and earnings horizon periods of 10 years has more significant correlation than the 1 year and 1 year. Although once the holding period gets past about 3 years or so, then our earnings horizon doesn't seem to matter that much. And in the shorter time periods here, the 1935 to 2012 and the 1962 to 2012 period, the earnings horizon doesn't matter too much for the entire distribution of return horizons. So really, using the normal PE ratio, which is basically 1 year of earnings horizon, has the same result as using the CAPI, which is about a 10-year earnings horizon. And what our return turns out to be is largely dependent on how long we hold the security, or in this case, the utility sector. And here we have figure 27, which is the same sensitivity analysis as before in figures 21 through 26. However, this time we're looking at railroads. The prior ones were utilities, industrials, and the overall stock market. So we see here that railroads, the relationships between the earnings horizon, return horizon, and the correlations are sort of all over the place, and it's very difficult to conclude to anything. And even as from looking at the prior tables and the prior charts and such, we've seen that railroads have had a tough time, or rather, based on our analysis, it's tough for us to hang our hat on anything related to the relationship of these variables for railroads. And again, we see these p-values are pretty high. These associations are sort of all over the place. What we do see, though, is that certainly longer-term earnings horizons do seem to have lower correlations. So in that way, the CAPI maybe is a better predictor of long-term returns in the railroads than is the normal PE ratio, which would be in this line here, which is significantly higher than the 10-year spot, which is this line. All right, so next here in figure 32, the authors have put together a hypothetical strategy based on the relative CAPI indicator, a sector rotation strategy where they rotate between the industrials, railroads, and utilities based on an investment score. Now, we remember the relative CAPI is basically just the CAPI ratio compared to the prior 20-year average, so relative to the prior 20-year average. And they rank each of the sectors according to that relative CAPI. So higher relative CAPIs would signify maybe that sector is overvalued, and lower CAPIs would signify that that sector is undervalued. And so their ranking process involves starting out all three sectors with a score of 2, and they add 1 to the sector with the lowest relative CAPI, and they subtract 1 to the sector with the highest CAPI. And this results in scores of 1, 2, or 3, and those scores are indicative of the weight in the portfolio. For instance, dividing their score by the sum of all of the scores. For instance, the highest relative CAPI might get a score of 1 divided by 6, or a portfolio weight of 1 divided by 6. The middle would get 2 divided by 6, and the lowest relative CAPE would get a weight of 3 divided by 6, so about half the portfolio. But they've added another complementary step, and that is for momentum. Now, if any of the sectors 1 year price change or return is the lowest out of the 3 sectors for 2 consecutive quarters, then that sector is given a score of 0 until it redeems itself. So using that strategy from the period of 1902 through 2012, we see that this rotation strategy that we just described outperforms the benchmark, which is the total stock market, and then also an equally weighted strategy. So if we gave each of the sectors 33% in the portfolio. And we see for a long while that the rotation strategy basically tracks the benchmark and equally weighted strategy for a while, up until looks like the 1970s. However, at that point, the rotation strategy starts to break away. And in fact, the rotation strategy turns $1 into $1,762. Excuse me, $1,756. The benchmark, the S&P 500 composite, turns $1 into $569. And then for the equally weighted strategy, it turns $1 into $856. So over this 110-year time period, the rotation strategy clearly outperforms the benchmark and an equally weighted strategy. So the authors have also put together a table of returns and risk-adjusted returns. So let's take a look at that. And here we have table 3, which shows the returns and risk-adjusted returns under several different time periods. So starting in 1902, or starting in 1935, or starting in 1962, going all the way up to 2012 for each of these. So the first number here is the return. The next number is the volatility. And then the bottom is the information ratio. So basically the return divided by the volatility. And we have those figures for both the sector rotation strategy that we described in the last table, as well as the equally weighted strategy, where each of the sectors gets 33% of the weight in the portfolio. And then also the market benchmark, which would be the total stock market, which is the S&P composite, as well as a bootstrapped version going back farther into history. But we see here that in all time periods, the CAPE-based sector rotation outperforms the equally weighted strategy and the market benchmark on a nominal basis, this top figure, as well as a risk-adjusted basis, which would be the information ratio. And these returns are net of inflation. But if the risk-adjusted returns are reported to you, it's interesting to see that the sector-based rotation strategy doesn't return as high, or it's not a significantly higher information ratio than the equally weighted strategy, although both strategies do handily outperform the market benchmark. And this might tell us that we might be capturing some small cap excess returns here, because equally weighted strategy will give more weight to smaller companies than the market benchmark, which weights the securities according to their market cap. So we get less of a showing of small cap stocks. But either way, we do see that the CAPE-based sector rotation strategy that they have put together does a good job outperforming the benchmark as well as the equally weighted strategy. Next, in figure 3, we have the portfolio weights for the rotation strategy. So we've got industrials up here, utilities right here, and railroads right here. It would have been a little easier to see this if they had made a chart that combines these and stacks them on top of each other. However, this is what we've got. So we can see that industrials are overweighted first, while the utilities are given 0%, assuming because of the momentum kick out. And then over the next little while, the industrials tend to get a lower and lower weighting in the portfolio as the utilities start to take over that weight. Meanwhile, the railroads really have a lot of volatility in the weighting in the portfolios, from 0 to almost 80% over and over. What's interesting to see is that the railroads don't get a very favorable weight in the portfolio for from maybe 1965 all the way to 1995. And then the industrials start to show a lot of overvaluation around the tech boom, and that's because the tech companies are in the industrials sector. So the strategy reduces its allocation to industrials in favor of utilities and railroads. And then shortly after then, industrials pick up the larger weight in the portfolio at the expense of the weight of utilities and railroads. Next, here in figure 34, we show the comparison of the rotation strategy to the equally weighted strategy. It's these two here, and also the rotation strategy and the benchmark here. And so these are the absolute returns. We see that some are above 0, some, and these are in 5-year increments. So each 5 years over the 1902 to 2012 period. And then in this bottom section, we have the excess of the rotation strategy over the equally weighted strategy. So it's easier to look at this one. So let's look at these, where we see looks like there's significantly more 5-year periods of outperformance of the rotation strategy over the equally weighted strategy. In addition, over the benchmark, really sizable 5-year period here in the early 2000s where the rotation strategy outperformed the benchmark. And we also see some big negative 5-year periods here, but the authors want to emphasize that this isn't significant negative returns of the rotation strategy. These are actually pretty good years for the rotation strategy. It's just that the equally weighted strategy or the benchmark had a little bit better in those years. So, for instance, here this was about a 100% 5-year period. So the CAPI returned about 20% a year, but it's showing negative because the equally weighted strategy outperformed a little bit more. And that turned out to be the case in this large negative figure as well, where the CAPI returned about 70% over a 5-year period cumulative. And so looking at the negative years, or the 5-year negative periods for the equally weighted strategy and for the benchmark, we see that the rotation strategy gets us at least the benchmark or the equally weighted portfolio, or a little bit better in most of the cases here. So since this rotation strategy is based on a value strategy, then in periods of very positive stock returns, when things are starting to get really heated, the strategy might not participate in those excess returns. However, it might allocate toward cheaper stocks cheaper sectors during periods of softness, which might prevent big downward spikes in returns. And finally, we have a couple more figures to show the excess returns of the CAPI strategy compared to the benchmark here. And the next figure will show excess returns related to the equally weighted portfolio. But what this chart shows here is what they call the outperformance ratio. So here is the time horizon in quarters. So they have from 0 to 40 quarters, and these are rolling quarter periods. I think an example will make this easier to understand. If they have at this 5 point, they are showing the number of times that the rotation strategy outperformed the benchmark over the 110-year period that we're studying with 5-year rolling quarters. So, and this will show the percentage of times that the rotation strategy outperformed the benchmark every 5 quarters over the next 110 years. So at that time, maybe about 52% of each 5-quarter period outperformed the benchmark. And we see here that as the time horizon gets longer and longer, the percentage of outperformance gets larger and larger as well. So this tells us that with 40 rolling quarters, time periods, then almost 70% of those 40-quarter periods over the 110 years turned out to be the rotation strategy outperforming the benchmark. And so down in this chart here, we still have these rolling quarters, but here we have the excess return for the rotation strategy versus the benchmark. So this solid line here is the excess return of the rotation strategy over the benchmark only when the rotation strategy outperforms. So we see here that as the time horizon gets longer and longer, the rotation strategy only beats the benchmark by about 4%. But in shorter rolling time horizons over the 110-year period, whenever the rotation strategy does beat the benchmark, then it's to the tune of about 10% or so. But importantly, what the authors want to emphasize here is this red line here is always below this black line. And this red line represents the excess return of the benchmark over the rotation strategy when the benchmark outperforms. So what this tells us is that the excess returns of the rotation strategy over the benchmark are higher than the excess returns of the benchmark over the rotation strategy. So the losses that we do have related to the strategy are always compensated by gains that we have from the strategy. So let's look at the same comparison with the equally weighted benchmark as well. And here we have figure 6, which is the same as figure 35. And we see that we have the same result against the equally weighted strategy, whereas the time horizon gets longer and longer for rolling time periods over the 110-year period. The up to about 40 quarters, that's 10 years, the rotation strategy outperforms the equally weighted strategy about 70% of these 40-quarter rolling periods. Also, we see that when the rotation strategy outperforms the equally weighted strategy, it's higher than the times that the equally weighted strategy outperforms the rotation strategy.